You are living through one of the greatest wealth building opportunities in history. Now that probably sounds completely insane right now. Turn on the news and what do you hear? Well, economic uncertainty, fears of a slowdown, market volatility, analysts are talking about a stall year. And something called the Great American Slowdown means many Americans are living in areas already feeling an economic pinch. While the national numbers might look stable, Moody's Analytic report that 22 states are already in or near a recession. For most people, this is a time of fear about their portfolio, their job, their future. But for a small part of people, this is the moment they've been waiting for. For the world's wealthiest, an economic downturn isn't a crisis, it's an opportunity. It's a Black Friday, sale on assets, a once-in-a-decade chance to buy the building blocks of generational wealth at a massive discount. They don't just survive these periods, they use them to get richer. And this isn't an accident, it's a playbook. And today, I'm pulling back the curtain. I'm going to lay out the exact financial playbook the rich use during times of panic and uncertainty. These are the strategies that allow them to turn fear into fortunes. By the end of this, you won't just understand why the rich love downturns, but you'll have a plan to start loving them too. So let's be very clear, a major market downturn is a wealth transfer. Money doesn't just vanish during a crash, it moves, it flows from the accounts of the impatient, the fearful and unprepared into the accounts of the patient, the strategic and the prepared. So the question you have to ask yourself is, which side of the transfer do you want to be on? The difference between those who lose their shirts and those who make a fortune isn't luck. It's not even about starting with $1 billion, it's about mindset and strategy. It's about seeing a sale while everyone else sees a crash. It's about having a plan when everyone else is panicking, and that's how you end up on the right side of it. The first rule, the foundation for everything else, has nothing to do with stocks or real estate. It's all psychology. The single biggest difference between the rich and everyone else during a market sell-off is their mindset. While the average person is glued to the news, watching the market ticker with a pit in their stomach, the wealthy are detached. They know the economic cycles are a natural part of the system. History shows that every major downturn in the US has eventually been followed by a period of recovery and expansion. It's a feature of the system, not a bug. They see widespread fear as a flashing green light. The legendary investor Warren Buffett famously said to be fearful when others are greedy and be greedy when others are fearful. And this isn't just some clever quote, it's the entire game plan. When headlines are screaming market panic and your neighbor is telling you they sold everything, that's a buy signal. For a savvy investor, it means assets are being sold for emotional reasons, not logical ones. And when things are sold out of emotion, they're almost always sold for less than they are truly worth. This mindset shift is your first and most important job. You have to deprogram the fear response that the 24/7 news cycle is built to trigger. A market correction is not the end of the world, it is the world on sale. Every great company whose stock is down 30, 40 or 50% is now cheaper to own. Think about it, if your favorite store had a 50% off sale, would you panic and run away? Of course not, you'd rush in to buy the things that you always wanted to at a better price. You need to view the stock market and other asset market the exactly same way. Once you've got the right mindset, it's all about preparation. Wealthy investors know that the most powerful tool in downturn is liquidity. They call it dry powder, cash ready to be deployed the moment opportunity strikes. When the economy is roaring and everyone's making money, holding cash feels boring. It earns next to nothing and gets eaten away by inflation. So many people feel like they need to be 100% invested all the time. But the rich know that cash has what's called option value. It gives you the option to act boldly when other people are forced to sell. During a downturn, cash is king. Why? Because as fear spreads, credit gets tight, bank gets nervous and stop lending as freely. People who are over leveraged or losing their jobs are forced to sell assets to pay their bills. They might have to dump their stocks, their investment properties, whatever it takes. They aren't selling because they want to, they're selling because they have to. This is where the person with dry powder swoops in. They get to buy high quality assets from forced sellers at a huge discount. Having cash on the sidelines also protects you from ever becoming a forced seller yourself. It's a safety net. If you have enough to cover your living expenses for 6 to 12 months, you won't have to touch your long-term investments. This is a defensive move that lets you play offense. It lets you sleep at night knowing your family is secure while you calmly look for the bargains the market is giving you. Building this cash reserve isn't something you do overnight. It's a discipline you build during the good times. It means setting aside a piece of your income not for a vacation but for an opportunity fund. While everyone else is busy chasing the last few percentage points of a bull run, the smart money is quietly taking some profits off the table and turning them into cash, just waiting for the party to end. With the right mindset and a pile of dry powder, you're ready for the fun part. You get to go shopping, but the rich don't just buy randomly. They're not trying to catch falling knives or betting on penny stocks they hope will bounce. They have a very specific shopping list. They are focused on one thing: quality. They're hunting for high quality assets that got thrown out with the bathwater during a market-wide panic. In the stock market, this means buying shares in fundamentally incredible companies. We're talking about businesses with a long history of being profitable, strong balance sheets with very little debt and a durable competitive advantage. What Buffett calls a moat. These are the companies that will absolutely survive the downturn and come out even stronger on the other side. Think about iconic brands, industry leaders, companies that sell things people need no matter what the economy is doing. During a panic, the market often stops differentiating between great companies and terrible ones. Everything just gets sold off. This is the mistake the average person makes. They see a sea of red in their portfolio and they just sell it all. The wealthy investor sees this as the perfect time to shift through the wreckage and pick up the gold. They buy shares of blue chip companies at a price they were dreaming of a year ago. They understand that even though the stock price is down 40%, the actual value of the business, its factors, its patents, its brand hasn't dropped by 40%. They're buying a future stream of earnings at a massive discount. This same idea applies to other assets like real estate. An economic slowdown often leads to a softer housing market. This can be a fantastic time to buy investment properties from motivated sellers at better price. The key is to focus on quality locations and properties that will generate positive cash flow from rent. While the paper value might dip for a while, that monthly rental income keeps coming up. The strategy is simple. Make a list of 10 to 20 amazing companies or types of properties you'd love to own if the price were 30 to 50% cheaper. Then you just wait patiently. When the market finally panics and those prices pop up, you execute your plan. While part of the plan is to go on offense and buy growth companies on the cheap, a huge part of the strategy is also playing defense. Wealthy investors build what you could call a fortress portfolio by putting a portion of their money into defensive sectors. These are industries that aren't as sensitive to the economic cycle. People buy their products and services whether the economy is booming or busting. The three classic defensive sectors are consumer staples, healthcare, and utilities. Think about it, in a downturn you might hold off on buying a new car or design a watch, but you're still going to buy a toothpaste, groceries, and soap. You still need electricity to power your home. You're still going to see a doctor and buy prescriptions. The demand for these things is incredibly stable. Companies in these sectors tend to have a very predictable revenue and cash flow. Even when things get rough, that makes their stock price a lot less volatile than companies in, say, the tech or travel industries. But they might not give you the explosive growth of tech stocks in a bull market. They provide a stability and protect your capital when you need it the most. They are the bedrock of the portfolio, the part that doesn't keep you up at night. Plus, many companies in these defensive sectors are mature, blue chip businesses that pay constant dividends, and that brings us to another key part of the wealthiest playbook. In a bull market, everyone is obsessed with growth. How much did my portfolio go up? But in a downturn, the focus shifts to preserving capital and generating income. The wealthy know you can still make a good money even when the stock prices are going sideways or down. The secret is cash flow. One of the main ways they do this is with dividend paying stocks. A dividend is just a piece of a company's profit that it shares with its shareholders. When you own a dividend stock, you're literally getting paid to hold it, no matter what the stock price is doing that day. During a downturn, this income stream is incredibly valuable. It acts as a cushion, offsetting some of the temporary drops in the stock price. Even better, you can reinvest those dividends to buy more shares of the company, often at those lower prices. This is a powerful wealth compounding machine. You're using the company's own money to increase your ownership at a discount. So when the market eventually recovers, you own more shares than you started with and your gains get magnified. Alongside dividends, the rich also use bonds to generate income and lower their portfolio's volatility. Now, bonds are usually less exciting than stocks, but they play a vital role in a recessionary portfolio. Central banks often cut interest rates during a downturn to stimulate the economy. When they do, existing bonds that pay a higher interest rate become more valuable. This can give you capital gains that helps offset losses in your stocks, but more importantly, high quality government and corporate bonds provide a predictable, stable income, adding another layer of defense and cash flow. This combination of dividend stocks and bonds creates a reliable income stream that not only pads your bank account but also gives you more dry powder to go buy other cheap assets as the downturn continues. This might be the most powerful yet overlooked strategy the rich use during a downturn. They don't just invest in existing existing assets, they create new ones. Downturns are a phenomenal time to start or scale a business. I know that sounds completely backward. It's the slowdown when you're supposed to cut costs and lay low. Yes, for unprepared businesses, but for a strategic entrepreneur, a downturn clears out the competition and makes resources cheaper. First, talent becomes available. During boom times, it's incredibly hard and expensive to hire top people, but during a slowdown, many talented people get laid off from bigger, less efficient companies. This creates a pool of amazing professionals who are looking for the next big thing. Second is the cost of doing business jobs. Office spaces get cheaper, advertising rates on platforms like Google and Facebook often go down as big companies pull back their spending. Equipment, software, you name it, everything can be negotiated for a better price. The entire infrastructure you need to build a business is basically on sale. And most importantly, downturns creates new problems that desperately need solving. The 2008 financial crisis gave birth to companies that reshaped our world. People couldn't afford hotels, so Airbnb was born in 2008. People couldn't afford taxis, so Uber was founded in 2009. These companies weren't just lucky, they were built to solve problems that became urgent during an economic crisis. They offered more affordable, efficient alternatives to old school industries. The rich understands this. They're either starting these new ventures themselves or acting as the venture capitalists who fund them. They aren't just buying assets, they're creating the assets of the future, right when the cost of creation is at its absolute lowest. So stop fearing recessions, start preparing for them. Your future self is going to thank you. Don't forget to like and subscribe, and I'll see you guys in the next video.